Stop what you're doing right now, because what happened after the arrest of President Maduro is not just another political episode meant to dominate the news cycle for a few days before disappearing into the archive of forgotten crises. It is a structural inflection point that sent deep, silent shockwaves through the oil, gold, and silver markets. And while the public conversation was consumed by legal arguments, diplomatic outrage, and ideological positioning, the markets did what they always do when something truly important happens. They ignored the noise and focused on the only variable that ever truly matters in commodities: control. Because commodities do not care about morality, democracy, or rhetoric. They care about authority, continuity, and enforceability. And the moment Maduro was removed from the equation, even temporarily, the assumption of continuity inside Venezuela's resource system fractured. And that fracture did not need to result in immediate production shutdowns, street violence, or dramatic visuals to matter. Because in commodity markets, perception of instability often moves prices long before instability becomes visible. And oil reacted first, not with panic buying or collapsing prices, but with something far more revealing: hesitation. A subtle but persistent repricing of risk that signaled the market was no longer comfortable assuming business as usual. Because Venezuela is not just another oil producer that can be replaced overnight. It sits on some of the largest proven oil reserves on the planet, and reserves alone do not move. Markets, deliverability does. And deliverability depends on contracts being honored, ports being insured, tankers being cleared, payments being settled, and governments being recognized by international financial systems. And the arrest instantly injected uncertainty into every one of those pillars, forcing traders, refiners, insurers, shipping firms, and governments to reassess exposure quietly and quickly. And this reassessment did not show up in dramatic headlines. It showed up in spreads widening forward curves, shifting insurance premiums creeping higher, and certain buyers stepping back, while others demanded deeper discounts. Because sophisticated capital does not announce fear. It encodes it into price. And this is why oil did not explode upward or crash downward. It stiffened. It became less liquid, more sensitive to rumors, more reactive to silence, because the market was no longer pricing barrels as neutral commodities. It was pricing barrels as politically complicated assets. And that distinction is critical because oil markets are forward-looking systems that trade expectations rather than present reality. And when expectations shift from stability to fragility, prices adjust long before supply does, and that adjustment immediately fed into inflation expectations. Because energy is the base layer of modern civilization, touching food production, transportation, manufacturing, chemicals, defense, logistics, and even digital infrastructure. And when energy risk rises, inflation risk follows almost automatically. And this is where gold enters the story, because gold does not respond to events directly. It responds to confidence. And after the arrest, gold's behavior was unusually telling, because it did not behave like a speculative asset. Chasing headlines or reacting emotionally, it behaved like an anchor, absorbing pressure quietly, refusing to break down even when short-term conditions suggested it should. And that refusal is not random, it is a signal. Because when gold ignores bearish catalysts, it means underlying demand is overwhelming paper-selling pressure, and that demand does not come from retail traders. Reacting on social media, it comes from central banks, sovereign funds, and institutions that think in decades rather than quarters. And the arrest of a leader in a resource-rich, geopolitically sensitive nation immediately raises uncomfortable questions about reserves, held abroad sanctions, enforcement asset, freezes payment systems, and the reliability of counterparties, especially in a world already fragmenting into competing political, economic, and monetary blocs. And gold is the only widely accepted asset that sits outside all of those systems, which is why it becomes attractive precisely when trust begins to erode. And while gold was quietly absorbing capital, silver was sending an even more subtle and arguably more important signal, because silver occupies a unique position at the intersection of monetary psychology and industrial necessity. And when oil uncertainty rises, governments do not retreat. They intervene. They subsidize energy. They expand defense budgets. They accelerate infrastructure projects. They push industrial policy, and every one of those responses consumes silver, from power grids and solar panels to electronics, weapon systems, medical devices, and communication infrastructure. And unlike oil, silver supply cannot be ramped quickly. And unlike gold, silver inventories are thin, opaque, and often already committed through long-term industrial contracts. And after the arrest, small but meaningful changes began to appear in the silver market. Tighter spreads between paper and physical, firmer premiums. In certain regions, longer delivery times for large orders. Nothing dramatic enough to dominate mainstream coverage, but all of it consistent with a system where buffers are shrinking. And silver has always behaved this way before major moves, disappearing quietly rather than announcing scarcity loudly. And what ties oil, gold, and silver together in this moment is not Venezuela itself, but trust. Trust in governance, trust in contracts, trust in the assumption that global supply chains will continue to function smoothly despite political shocks. And when that trust weakens, markets do not collapse instantly. They harden. Liquidity thins. Reactions become sharper. Volatility becomes structural rather than episodic. And this is the environment the arrest pushed us further into, because it reminded markets of a truth they prefer to forget, that control over resources is political, fragile, and reversible. And once that truth is internalized, assumptions that once felt permanent begin to look conditional, and conditional assumptions are deadly for pricing models because models depend on continuity. And continuity was exactly what this event called into question. And this is why the real impact of the arrest should not be measured in daily price charts or short-term volatility, but in positioning, flows, and behavioral shifts, because oil began pricing risk rather than abundance. Gold began absorbing doubt rather than speculation, and silver began tightening rather than advertising. And these three reactions together form a pattern that has repeated throughout history whenever political authority shifts in resource. Heavy regions, because history shows us that when control becomes uncertain, capital does not wait for confirmation. It moves preemptively, seeking insulation from disorder, and that movement is rarely loud at first. It is quiet, technical, almost invisible to those not watching closely, and yet it reshapes markets in profound ways over time because once participants begin demanding higher compensation for risk, that demand becomes embedded, shaping contracts, investment decisions, and strategic planning long after the original event fades from memory, and the arrest of Maduro did not create this fragility. It exposed it, pulling forward concerns that were already present but not yet fully priced. Concerns about sanctions, durability, about political legitimacy, about energy security, about the reliability of global trade routes. And this is why the true impact of the event unfolds slowly, through recalibration rather than explosion. Because after this moment, the baseline assumption of stability weakened, the cost of uncertainty increased, and the margin for error narrowed. And uncertainty is not just noise. It is the raw material from which major commodity repricings are eventually formed, especially in a global system already stretched by historic debt levels, intensifying geopolitical rivalry, energy insecurity, and declining trust in institutions. And this is where the story becomes even more significant. Because Venezuela is not an isolated case, it is part of a broader pattern in which resource-rich nations become pressure points in a fragmented global order. And every time such a pressure point destabilizes, it forces markets to reevaluate assumptions that once felt unbreakable. Assumptions about uninterrupted flow, about enforceable contracts, about predictable governance. And when those assumptions weaken, markets respond not with chaos, but with caution. And caution in markets manifests as higher premiums, tighter liquidities, and increased sensitivity to shocks. And this sensitivity creates an environment where relatively small events can produce outsized reactions, because buffers are thinner and confidence is weaker. And the arrest of Maduro occurred in precisely such an environment where the global system was already carrying multiple unresolved stresses, from energy transitions to trade wars to sovereign debt burdens. And adding another layer of political uncertainty to a major resource holder acts not as a trigger for immediate collapse, but as a weight added to an already strained structure, and structures under strain do not fail immediately. They creak, they shift, they redistribute load, and oil, gold, and silver are the instruments that reveal where that load is being redistributed. Because oil reflects the cost of moving the physical world. Gold reflects the level of trust in the system managing that world. And silver reflects the strain inside the industrial backbone that supports it. And after the arrest, all three began telling the same story in different languages. A story of rising friction, conditional stability, and shrinking margins for error. And this story matters because markets are not static. They evolve based on expectations. And expectations are shaped by precedent. And the precedent set here is that political authority over strategic resources can change abruptly with global implications. And once markets internalize that lesson, they do not forget it easily, because forgetting it would require rebuilding trust. And trust is far harder to rebuild than to lose, especially in an era where information travels instantly and uncertainty compounds quickly. And this is why the arrest of Maduro should be understood not as an endpoint, but as a signal that the era of assuming smooth continuity in global resource markets is fading, and that assumption was the foundation upon which many pricing models, investment strategies, and policy decisions were built. And when foundations crack, even slightly, everything above them becomes more fragile, and the markets are already adjusting to that fragility, not with panic, but with preparation. And preparation always happens before the public realizes what is changing, because by the time change becomes obvious, it is no longer new, it is already priced, already absorbed, already shaping outcomes. And this is why what happened after the arrest matters far more than the arrest itself, because it revealed how quickly confidence can shift, how quietly capital can move, and how interconnected oil, gold, and silver truly are when the system is under stress. And this realization sets the stage for what comes next, because once a system begins to price instability as a baseline rather than an exception, the entire logic of markets changes, and that change does not reverse overnight. It unfolds over time, shaping the trajectory of prices, policies, and power in ways that are only visible in hindsight. And once that trajectory begins, it does not move in a straight line. It curves, bends, and occasionally accelerates in ways that confuse observers who are still trying to interpret events through the lens of the old system, because the second-order effects of a political shock are always more powerful than the first. And this is where the story truly deepens. Because after the initial repricing of risk, after oil stiffened gold, absorbed doubt, and silver tightened quietly, the next phase began the phase where governments, institutions, and large pools of capital stopped reacting and started repositioning. And repositioning is far more consequential than reaction, because reaction is temporary, repositioning is structural. And in the weeks and months following the arrest, energy buyers did not simply look at Venezuela as a single source of supply that might or might not return to normal. They began viewing it as a symbol of something larger, the growing instability of politically concentrated resource control. And this perception triggered a subtle but powerful shift in strategy, where diversification stopped being a theoretical best practice and became an operational necessity, because refineries that once relied on discounted Venezuelan crude began exploring alternative blends. Shipping companies quietly adjusted routes and contracts to reduce exposure. Insurers recalculated political risk premiums, not just for Venezuela, but for similar regimes. And these changes did not make headlines, but they rewired the plumbing of the energy market, because oil markets are not just about barrels in the ground. They are about trust networks, and once trust networks fracture, even partially, the cost of moving oil rises permanently, not because oil disappears, but because every intermediary demands compensation for uncertainty. And this compounding cost feeds directly into inflation, fiscal stress, and monetary policy, which is why central banks were watching this event far more closely than they publicly admitted. Because central banks understand that inflation is not just a function of money supply, it is a function of energy stability. And energy stability was already fragile before the arrest, strained by underinvestment, geopolitical fragmentation, and the slow, uneven transition toward alternative energy systems. And adding another variable of political disruption into that equation pushed policymakers into a defensive posture, where preserving credibility became more important than stimulating growth. And this defensive posture naturally reinforced gold's role. Because when central banks feel boxed in, unable to cut rates aggressively without reigniting inflation, and unable to hike aggressively without breaking debt markets, they look for neutral anchors, and gold is the only asset that does not belong to anyone else's balance sheet. And as this realization spread, gold demand did not spike violently, it persisted. Because persistent demand is more dangerous to shorts than spikes. Spikes can be faded, persistence cannot. And this persistence quietly undermined the paper gold market, where leverage and rehypothecation depend on the assumption that physical delivery will never be demanded at scale. And while no single event caused a collapse, the arrest added another layer of incentive for sovereign actors to reduce exposure to paper claims and increase exposure to physical reserves, especially outside the Western financial system. And this trend, already visible before the arrest, gained momentum afterward. Because once you see political authority challenged, you begin questioning legal authority. And once legal authority is questioned, asset claims become conditional. And conditional claims are inferior to physical possession. And this logic applies even more forcefully to silver, because silver sits at the uncomfortable intersection of financial abstraction and physical necessity. And unlike gold, which can be hoarded indefinitely with relatively little impact on the real economy, silver cannot disappear without consequences. Because it is consumed, embedded, transformed, and when silver inventories tighten, the effects ripple outward into supply chains that governments cannot afford to disrupt, especially in a world increasingly dependent on electrification, digital infrastructure, and military technology. And after the arrest, governments began accelerating projects designed to reduce dependency on unstable regions. And acceleration means demand pulled forward, and pulled forward demand collides with constrained supply. And this collision is where silver's true volatility lives. Because silver does not need a collapse to explode, it only needs a mismatch. And mismatches are created not by dramatic shortages, but by incremental pressure applied consistently over time. And the arrest contributed to that pressure by reinforcing the idea that supply chains anchored to politically volatile regimes are liabilities, not assets. And as capital rotated, something else began to happen beneath the surface. Speculative narratives started to change. Because narratives follow price, but they also shape future price by attracting or repelling capital. And the narrative shifted from abundance and control to fragility and contestation. And once that narrative takes hold, it reshapes how investors interpret every subsequent data point. Because in a stable narrative, disruptions are dismissed as noise, but in a fragile narrative, even small disruptions are amplified. And this amplification creates reflexivity, where perception drives behavior and behavior reinforces perception. And this reflexivity is what transforms political events into long-term market trends. And it is precisely this mechanism that turned the arrest from a regional political drama into a global market signal. Because it did not occur in isolation, it occurred against a backdrop of rising geopolitical polarization, weaponization of financial systems, and declining faith in multilateral institutions. And in such an environment, every demonstration of political instability in a resource-rich state is interpreted not as an anomaly, but as confirmation of a broader pattern, and confirmation strengthens conviction, and conviction moves capital, and capital movement is the true engine of market change. And as conviction grew, long-term investors began adjusting portfolios not in dramatic reallocations, but through gradual tilts slightly higher. Commodity exposure, slightly lower reliance on complex derivatives, slightly more emphasis on physical assets, infrastructure, and strategic materials. And these tilts matter because they accumulate. And over time accumulated, tilts become trends. Trends reshape price floors, not just price ceilings. And this is where the arrest's most profound effect may ultimately reside, not in triggering a spike, but in lifting the baseline, raising the minimum price at which oil, gold, and silver can sustainably trade. Because when risk premiums rise and remain elevated, prices must compensate or supply will not be delivered. And this dynamic feeds back into politics because higher energy prices strain budgets, exacerbate inequality, and increase pressure on governments already struggling to maintain legitimacy, creating a feedback loop where political instability and commodity volatility reinforce each other. And Venezuela becomes not just a case study, but a warning, because it illustrates how quickly control over resources can become contested, how rapidly legitimacy can be questioned, and how decisively markets respond when they sense that the old guarantees no longer apply. And this realization has implications far beyond oil, gold, and silver, because it touches the very architecture of globalization, which was built on the assumption that economic integration would reduce political conflict, an assumption that is now being reversed as political conflict increasingly shapes economic integration. And in such a world, commodities regain strategic importance, not as tradable goods, but as instruments of power. And power dynamics always introduce volatility, because power is contested, negotiated, and occasionally seized. And markets do not like contested power. They price it defensively. And defensive pricing raises costs, tightens liquidity, and increases the probability of shocks. And this is why the arrest should be viewed as part of a transition from a rules-based commodity order to a power-based one, where access matters more than price, and security matters more than efficiency, and resilience matters more than optimization. And in this transition, gold serves as the neutral reserve, oil as the contested lifeblood, and silver as the pressure gauge. And after the arrest, all three began behaving less like passive assets and more like strategic indicators, reflecting not just supply and demand, but the state of the system itself. And systems under stress reveal their weaknesses gradually through anomalies, delays, bottlenecks, and mispricings. And attentive observers notice these anomalies increasing, not exploding, but accumulating. And accumulation is dangerous because it creates latent energy, and latent energy eventually releases, often triggered by events that seem insignificant on their own, but catastrophic in combination. And this is why the most important question is not whether the arrest caused an immediate crisis, but whether it moved the system closer to a threshold, because thresholds are invisible until crossed, and once crossed, they cannot be uncrossed easily. And history is full of moments that seemed minor at the time, but obvious in retrospect. Moments when trust eroded just enough to make future shocks far more destructive. And the arrest fits this pattern, not as a singular cause, but as an accelerant speeding up processes already underway. Processes of fragmentation, de-dollarization, strategic stockpiling, and renationalization of resource policy. And these processes directly affect how oil is priced, how gold is accumulated, and how silver is consumed, and they also affect how volatility propagates. Because fragmented systems lack the buffers that once absorbed shocks, making them more sensitive, more reactive, and more prone to cascading failures. And cascading failures are what markets fear most, because they are nonlinear, unpredictable, and difficult to contain. And when markets begin to sense that cascading risk is rising, they demand compensation in advance, raising prices, tightening credit, and withdrawing liquidity. And this preemptive withdrawal is itself destabilizing, because it reduces flexibility, and reduced flexibility increases the impact of future shocks, creating a vicious cycle. And breaking such cycles requires restoring trust, but trust cannot be restored by decree. It must be earned through stability, transparency, and enforceable rules. all of which are increasingly scarce in a polarized world. And this scarcity elevates the value of assets that exist outside political discretion, which is why gold continues to matter, and why silver's strategic importance is growing, and why oil remains the ultimate lever of influence. And the arrest brought all of these dynamics into sharper focus, forcing markets to confront uncomfortable truths about the fragility of the systems they rely on. And while the immediate aftermath may appear calm to casual observers, calm is often the most dangerous phase, because it lulls participants into underestimating risk, even as underlying pressures build. And those pressures do not dissipate on their own. They either find release or they reshape behavior permanently. And in this case, behavior is already reshaping, slowly, methodically, and largely out of public view. And by the time the consequences become undeniable, the opportunity to prepare will have passed, because markets move first and explain later, and what happened after the arrest was the market moving, quietly but decisively, away from assumptions of permanence and towards strategies of protection. And once that shift occurs, it defines the era, not the event, because events fade, but eras persist. And the era that is emerging is one where political risk is inseparable from commodity pricing, where energy security is national security, where monetary neutrality is prized, and where industrial inputs are strategic assets and oil, gold, and silver sit at the center of this transformation, not because they changed, but because the world around them did. And understanding this transformation is essential because it reveals that what we are witnessing is not a temporary disruption, but a reordering, subtle, uneven, and incomplete, but unmistakable to those who know where to look. And the arrest was one of those moments that pulled the curtain back, briefly, allowing us to glimpse the machinery underneath before it continued operating as if nothing had happened, even though everything had changed.